You know what's fascinating? Right now, as I'm recording this, there are people sitting on the sidelines watching silver, thinking they have time. They're waiting for a pullback, waiting for confirmation, waiting for the perfect entry point. And while they're waiting, something extraordinary is happening in the silver market that most people won't understand until it's already too late. Let me show you what I mean. 3 weeks ago, silver was trading at $28 an ounce. Nothing special, right? Just another day in the precious metals market. But if you knew where to look, if you understood what was happening beneath the surface, you would have seen the warning signs. The industrial buyers were getting aggressive. The mints were running low on inventory. And the smart money, the people who move markets, they were quietly accumulating positions while everyone else was distracted by the stock market hitting new highs. Fast forward to today. Silver just broke through $32. That's a 14% move in 3 weeks. And here's what nobody's talking about. This isn't a speculative rally. This isn't retail investors piling into silver ETFs hoping to make a quick buck. This is something much bigger, much more fundamental, and much more dangerous if you're not positioned correctly. I want to tell you about a conversation I had last week with a supply chain manager at one of the largest solar panel manufacturers in the world. This guy oversees procurement for a company that uses millions of ounces of silver every single year. And he told me something that should terrify anyone who thinks they can wait to buy silver. He said his company is now paying premiums of up to 15% over spot price just to secure physical delivery. 15%. That means when silver is trading at $32 on the COMEX, his company is actually paying nearly $37 to get the metal they need for production. Why would a sophisticated industrial buyer pay that kind of premium? Because they can't get the silver any other way. The physical market is that tight. And this isn't just happening in solar. It's happening in electronics manufacturing. It's happening in medical device production. It's happening across every major industrial sector that depends on silver. These companies aren't buying silver because they think the price is going up. They're buying silver because without it, their production lines shut down. Now, let me connect some dots that Wall Street doesn't want you to see. In 1980, silver hit $50 an ounce. Everyone knows that story. The Hunt brothers tried to corner the market. Regulators stepped in, and the price collapsed. But here's what most people don't know. In 1980, global industrial demand for silver was roughly 300 million ounces per year. Today, industrial demand alone is over 600 million ounces annually. We're using twice as much silver for industrial purposes as we were at the peak of the last major silver rally. But it gets better. Or worse, depending on your perspective. In 1980, there were no solar panels consuming massive amounts of silver. There were no electric vehicles requiring silver for their electrical systems. There was no 5G infrastructure build-out demanding silver for its superior conductivity. The industrial demand we're seeing today is structural. It's not going away. In fact, it's accelerating. Let me give you some numbers that should make you sit up and pay attention. The Silver Institute just released their latest supply and demand report. Global silver mine production last year was 822 million ounces. Total demand, including industrial, jewelry, silverware, and investment, was 1.2 billion ounces. That's a deficit of nearly 400 million ounces. Where did that extra silver come from? Existing stockpiles, recycling, government sales. But here's the problem. Those sources are finite, and they're running dry. I want you to think about what happens when you have structural demand exceeding supply by 30% year after year. At first, nothing seems to change. Prices stay relatively stable because there are stockpiles to draw from. But eventually, you hit a tipping point. The stockpiles run out. The recycling can't keep up. And suddenly the price has to rise dramatically to either bring new supply online or destroy demand. We're approaching that tipping point right now. There's a mine in Peru that I've been following closely. It's one of the largest primary silver mines in the world, producing about 20 million ounces per year. Last month, the workers went on strike over safety concerns and wage disputes. The mine has been shut down for 3 weeks. 20 million ounces of annual production offline, in a market that's already running a 400 million ounce deficit. And here's the thing. This isn't making headlines. CNBC isn't talking about it. Bloomberg barely mentioned it, but the industrial buyers know, and they're scrambling. Now, I need to take a quick detour here because this connects to something important for a lot of people watching this. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, or 401ks, you need to understand that there are ways to get physical precious metals into those accounts without triggering tax penalties. I put together a comprehensive guide on how gold IRAs work, how you can diversify your retirement savings with physical metals, and what the process actually looks like. It's completely free. Link is in the description below. Worth checking out if you're thinking about protecting your retirement savings from what's coming in the currency markets. All right, back to what's happening with silver right now. Let's talk about the COMEX for a minute because this is where things get really interesting. The COMEX is where silver futures are traded. It's the primary price discovery mechanism for the global silver market. And right now, there are some very unusual things happening on the COMEX that suggest we're heading for a major price dislocation. Registered silver inventory on the COMEX, that's the silver that's actually available for delivery against futures contracts, has dropped to just under 60 million ounces. 60 million ounces might sound like a lot, but consider this. There are currently open interest positions representing over 900 million ounces of silver. That's a ratio of 15 to 1. For every ounce of physical silver available for delivery, there are 15 ounces worth of paper claims against it. Now, most of the time, this doesn't matter. Most futures contracts are settled in cash, not physical delivery. Traders are just speculating on price movements. They don't actually want the metal. But what happens when industrial buyers start standing for delivery? What happens when investors lose confidence in paper silver and demand physical? You get a squeeze. And not the kind of squeeze that Reddit traders tried to engineer a few years ago. A real squeeze, driven by fundamental supply and demand imbalances. I want to tell you about what happened in March of 2020. Remember the COVID panic? Markets were crashing, everyone was scrambling for liquidity, and something very strange happened in the silver market. The spread between paper silver prices on the COMEX and physical silver prices in the retail market exploded. You could buy silver futures for $15 an ounce, but if you wanted to buy physical silver coins or bars, you were paying $25 to $30. A $10 to $15 premium over spot. Why? Because there was no physical silver available. The mints couldn't keep up with demand, the dealers were sold out. And suddenly, all those paper contracts weren't worth much if you couldn't actually get the metal. That was a temporary dislocation caused by a panic. It resolved itself once the mints caught up and retail demand cooled off. But what we're seeing now is different. This isn't panic buying. This is structural demand from industrial users who need silver for production, combined with investment demand from people who understand what's happening to the dollar. And the supply situation is worse now than it was in 2020. Let me give you another data point. The U.S. Mint sold 47 million silver eagles in 2020. Last year, they sold 24 million. Sales are down, right? Market must be cooling off. Except that's not what's happening. The mint isn't selling fewer coins because demand is down. They're selling fewer coins because they can't get enough silver blanks to produce more. They're rationed. The same thing is happening at the Royal Canadian Mint, the Perth Mint in Australia, and mints around the world. They want to sell more product, but they can't source enough physical silver to meet demand. Now, let's talk about what's happening in China, because this is the part of the story that most Western analysts are completely missing. China is the world's largest producer of solar panels. They're also the world's largest consumer of silver for industrial purposes. And over the past 18 months, Chinese entities have been quietly accumulating massive amounts of physical silver. Not paper silver, not ETF shares. Physical metal stored in warehouses in Shanghai and Hong Kong. Why would China be stockpiling silver? Think about the geopolitical situation. China is trying to reduce its dependence on the US dollar. They're building out the Belt and Road Initiative, which requires massive amounts of infrastructure and industrial production. They're investing heavily in renewable energy and electric vehicles. All of these initiatives require silver. And if you're China, and you're looking at a global silver market that's running structural deficits, what do? You secure your supply now, before prices go parabolic. There's a parallel here to what happened with rare earth elements 15 years ago. China controlled 90% of global rare earth production. They started restricting exports. Prices went crazy. Western countries scrambled to develop alternative sources, but it took years. Silver isn't quite the same situation, but the principle is similar. If major industrial consumers start hoarding physical silver because they're worried about future availability, it creates a self-fulfilling prophecy. The hoarding itself tightens the market further, which drives prices higher, which incentivizes more hoarding. Let me tell you about a fund manager I know who runs a billion-dollar commodity fund. Smart guy, been in the markets for 30 years. 6 months ago, he started building a position in physical silver. Not futures, not mining stocks, physical metal stored in allocated accounts. I asked him why. He said something that stuck with me. In a world where everything is financialized, where every asset is just a claim on someone else's promise, physical commodities are the only things that are real. And silver is the most undervalued real asset I can find. Think about what he's saying. We live in a world of unprecedented monetary expansion. The Federal Reserve's balance sheet went from under $1 trillion in 2008 to nearly $9 trillion at its peak. The European Central Bank, the Bank of Japan, the People's Bank of China, they've all been printing money at historic rates. And all that money has to go somewhere. It's gone into stocks, pushing valuations to levels that make no fundamental sense. It's gone into real estate, pricing an entire generation out of home ownership. It's gone into bonds, driving yields to zero or negative. But it hasn't gone into silver. Not yet. Silver is still trading at prices that, when adjusted for inflation, are below where it was in 1980. Think about that. 45 years of monetary inflation, 45 years of increasing industrial demand, and silver is cheaper in real terms than it was at the peak of the last major rally. That's not sustainable. Something has to give. Now, I want to address the argument that skeptics always make. They say, if silver is so valuable, why isn't the price higher? Why aren't mining companies ramping up production? It's a fair question, and the answer reveals something important about how commodity markets work. Mining is a capital-intensive business with long lead times. It takes 7 to 10 years to bring a new mine from discovery to production, and that's if everything goes right, which it rarely does. You need permits, which can take years to obtain. You need infrastructure, roads, power, water. You need to raise capital, which means convincing investors that the project will be profitable. And you need sustained high prices to justify the investment. Here's the problem. Silver prices have been suppressed for so long that mining companies haven't invested in new production. Why would they? If you're a mining executive and you've watched silver bounce between $15 and $30 for the past decade, are you going to bet hundreds of millions of dollars on a new mine? Probably not. You're going to focus on gold or copper or other metals with more stable price trajectories. But now, we're starting to see the consequences of that underinvestment. Primary silver mines, mines that produce silver as their main product, are declining. Most silver production today comes as a byproduct of gold, copper, lead, and zinc mining. And when those base metal prices are weak, silver production falls even if silver prices are rising. It's a structural problem that can't be fixed quickly. There's a mine in Mexico that illustrates this perfectly. It's been producing silver for over 100 years. 10 years ago, it was producing 15 million ounces per year. Today, it's producing 8 million ounces. The ore grades are declining. The easy silver has been mined. To maintain production, they'd need to invest in deeper drilling, more processing capacity, better technology. But with silver prices where they've been, that investment doesn't make economic sense. So production declines, and the supply deficit gets worse. Let me give you another angle on this. The gold to silver ratio. Historically, silver has traded at a ratio of about 15 to 1 relative to gold, meaning if gold is $1,000, silver should be around $67. Right now, gold is trading around $2,700. Silver is at 32. That's a ratio of 84 to 1. Silver is dramatically undervalued relative to gold by historical standards. Now you might say, historical ratios don't matter. Markets can stay irrational longer than you can stay solvent. And you'd be right. But here's the thing. That ratio exists for a reason. It reflects the relative scarcity and utility of the two metals. And when you have a situation where industrial demand for silver is growing faster than supply, while gold is primarily a monetary metal with stable demand, that ratio has to compress. It's not a question of if, it's a question of when. I want to tell you about what happened in 2011 because there are some eerie parallels to today. In 2010, silver was trading around $18. The economy was recovering from the financial crisis. The Fed was running quantitative easing, and silver started to move. By April of 2011, it hit $49. That's a 170% gain in less than 18 months. What drove that rally? A combination of factors. Investment demand surged as people looked for inflation hedges. Industrial demand was strong as the global economy recovered. And there were concerns about supply, particularly from Mexico, which is the world's largest silver producer. Sound familiar? But here's what's different this time. In 2011, that rally was driven primarily by investment demand. Retail investors and hedge funds piling into silver ETFs and futures. When the price got too high too fast, those speculative positions unwound and silver crashed back down to $26 within a few months. Today, the demand is more fundamental. Yes, there's investment demand. But the real driver is industrial consumption that isn't going away. Solar panel manufacturers can't just stop buying silver because the price goes up. Electric vehicle makers can't substitute another metal for silver in their electrical systems without massive retooling costs. The demand is sticky, and that means any price rally is likely to be more sustained. There's another factor that nobody's talking about: the energy transition. Governments around the world have committed to net zero carbon emissions by 2050. That means massive build-outs of solar, wind, and battery storage. The International Energy Agency estimates that achieving net zero will require tripling renewable energy capacity by 2030. And every single solar panel requires silver, about 20 grams per panel, which doesn't sound like much until you multiply it by billions of panels. Let me put some numbers on this. Current solar installations use about 130 million ounces of silver per year. If we triple solar capacity by 2030, that's 390 million ounces per year just for solar. Add in the silver needed for electric vehicles, 5G infrastructure, and other green technologies, and you're looking at industrial demand alone exceeding total global mine production. Where's that silver going to come from? The bulls will tell you that technology will solve this. They'll develop silver-free solar panels, or they'll find ways to use less silver per panel. And they're right, that's happening. But it's not happening fast enough. The latest generation of solar panels actually uses more silver than previous generations because they're more efficient, and efficiency requires better conductivity, which means more silver. I spoke with a materials scientist who works on solar panel development. He told me that yes, they're working on reducing silver content, but even in the best-case scenario, they can maybe reduce silver usage by 30% over the next 5 years. Meanwhile, solar installations are growing at 15 to 20% per year. You do the math. Even with technological improvements, total silver demand for solar is going to increase dramatically. Now, let's talk about what this means for you. Sitting here watching this video, you're probably thinking one of two things. Either you're convinced that silver is going higher, and you want to know how to position yourself. Or you're skeptical, and you think I'm just another precious metals pumper trying to get you to buy something. If you're in the second camp, I get it. The precious metals community has been predicting the collapse of the dollar and the rise of gold and silver for decades. And for most of that time, they've been wrong. Stocks have gone up. The dollar has remained the world's reserve currency, and silver has gone nowhere. But here's what I'd ask you to consider. Just because something hasn't happened yet doesn't mean it won't happen. The conditions that the gold and silver bugs have been warning about, massive monetary expansion, unsustainable debt levels, loss of confidence in fiat currencies, those conditions are more extreme now than they've ever been. At some point, the fundamentals matter. At some point, you can't keep printing money without consequences. And even if you don't believe in the monetary collapse scenario, even if you think the dollar will remain strong and the Fed has everything under control, you still have to deal with the supply and demand fundamentals in the silver market. Industrial demand is growing. Supply is constrained. That's not a conspiracy theory. That's just math. So what do you do? If you're convinced that silver is heading higher, you have several options. You can buy physical silver, coins or bars, and store them yourself, or in allocated storage. You can buy silver ETFs, though you need to understand that most ETFs are backed by unallocated silver, which means you don't actually own specific bars. You can buy silver mining stocks, which give you leveraged exposure to silver prices but come with company-specific risks. Or you can trade silver futures, which is the most leveraged option but also the riskiest. My personal view, and this is not financial advice, just my opinion, is that physical silver makes the most sense for most people. Yes, you pay premiums over spot price. Yes, you have to deal with storage. But you own something real, something that can't be printed or created out of thin air. And in a world where everything is increasingly digital and abstract, there's value in that. But here's the critical point, and this is why I titled this video the way I did. If you're going to buy silver, you need to move fast, not because I'm trying to create artificial urgency, but because the market dynamics are changing rapidly. 3 months ago, you could buy silver eagles for $3 over spot. Today, premiums are $5 to $7 over spot. 6 months from now, if the supply situation continues to tighten, those premiums could be $10 or $15 over spot. Or physical silver might not be available at any price. Remember what I told you about that supply chain manager paying 15% premiums to secure industrial silver? That's happening right now in the wholesale market. It's only a matter of time before those premiums filter down to the retail market. And when they do, the price you see quoted on financial websites won't matter. What matters is what you actually have to pay to get physical metal in your hands. There's a concept in markets called price discovery. It's the process by which markets determine the fair value of an asset. For decades, price discovery in silver has happened on the COMEX, in the futures market. But increasingly, the real price discovery is happening in the physical market. It's happening in the premiums that industrial buyers are paying. It's happening in the spreads between paper and physical. And that real price is significantly higher than what the futures market is telling you. I want to close with a thought experiment. Imagine it's 2 years from now. Silver is trading at $75 an ounce. The solar build-out has accelerated. A major mine in Peru or Mexico has gone offline due to political instability. China has restricted silver exports. And suddenly, everyone who was sitting on the sidelines is trying to buy silver at the same time. What do you think happens to premiums? What do you think happens to availability? You'll be competing with industrial buyers who need silver for production. You'll be competing with institutional investors who are finally paying attention. You'll be competing with foreign governments who are trying to secure strategic reserves. And you'll be paying whatever price the market demands if you can get silver at all. Or you could act now, while premiums are still reasonable, while physical silver is still available, while most people are still ignoring what's happening in this market. The choice is yours. But understand that this window is closing. The smart money is already positioned. The industrial buyers are already scrambling, and the supply situation is getting tighter by the day. This isn't about fear, it's about recognizing reality. The silver market is broken. Supply and demand are fundamentally out of balance, and when markets are out of balance, they eventually correct. Sometimes gradually, sometimes violently, but they always correct. The question is whether you'll be positioned correctly when it happens, or whether you'll be one of the people watching from the sidelines, wishing you'd acted when you had the chance.